Supermicro stock is down roughly 17% as I am recording today's episode. And while most of you might know that I'm not the biggest Supermicro bull, I do believe this sell off is a bit crazy, and the reason why it's even crazier. So, on today's episode, I want to talk a little bit about the sell off and why maybe investors might not be too worried about it, and then just share my overall thoughts. So, let's get started with today's episode.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
So we can see right now in quick price action, Supermicro is down almost 18%, sitting at $761, down $166. If we take a closer look at the past month, the stock is down roughly 16%. Year to date, the stock is still dominating, up over 166%, and in the past year the stock is up over 591%. Now obviously, unfortunately, if you picked up at that peak, the stock is down over 36% right now. So for those that are not familiar, Supermicro is a fan favorite in the AI market because they do create AI server solutions, and obviously with the AI market booming, Supermicro is booming with it, and we're seeing huge revenue growth. Now, today, the main reason the stock seems to be down is obviously there's a lot of things impacting the overall economy right now. Tensions in the Middle East, we do see kind of the overall tech space on a red day today. We're also hearing macroeconomics in general. But more importantly, it seems like today, Supermicro drops near 2-month low on earnings concern. They did have a lack of a pre-announcement, which could be a risk, says Wells Fargo. So some of you might be wondering, Jose, what is a pre-announcement and why is this a risk? So on today, April 19th of 2024, Supermicro announced that they are going to report their third quarter fiscal 2024 earnings on April 30th of 2024. So about 11 days from now, so less than 2 weeks. I'm pretty excited. Even though I mentioned I'm not the biggest Supermicro bull, I do like listening to their earnings call because they do share a lot of great insight about the AI market, maybe capex that we might be seeing from big tech players. So even if you're not a bull, I definitely recommend taking a listen at Supermicro earnings because they do share a lot and a lot of results. Now, the reason some analysts and some people are worried is because in those past 5 quarters, 4 out of those 5 quarters, Supermicro has reported preliminary results. Before we go any further, we are now on the road to 50,000 subscribers by the end of the year. Thank you all for the crazy support. So if you haven't and are enjoying the content, make sure to hit the thumbs up and the subscribe button. Finally, if you want to support the channel a little bit more, make sure to check out my special offer at fool.com/Jose. Now back to today's episode. For example, in their last quarter, the second quarter of fiscal 2024, on January 18th, they gave preliminary results that they said, hey, look, our sales are actually a lot better than what we guided for. So here are the real numbers we're looking at. So that was last quarter. Now the next quarter they did it was the fourth quarter of fiscal 2023. So they did it on the second quarter of 2024. They skipped the first quarter of 2024, and they did it previously again in the fourth quarter of 2023. And very similar, they said, hey, look, our net sales are a lot better than what we guided. So here are the real numbers before we report earnings. They did it again in the third quarter of 2023. This time it was the opposite. It was on the negative side. They said, hey, look, our guidance was actually too high. We're bringing it back down. These are our numbers. Then we can see they gave it again in the second quarter of 2023 when they said, hey, look, our numbers are a little bit better than we previously expected. So it seems like maybe this analyst and a lot of investors were hoping that Supermicro would come out and say, hey, look, our guidance was weak. Here are the actual numbers. Now, I don't believe it's necessarily something that Supermicro has to do, but Supermicro, obviously, there's a lot of supply chain issues here in the AI space, and Supermicro has kind of seen some few regulatory events where they might have fluxed some numbers in the past, where Supermicro, I guess, felt the need that they wanted to be more upfront earlier before earnings. I don't know if that's the case, but it's not a necessity for them to do that. So obviously, by them not giving us a report, it's pretty much just like any other company, a preliminary report, where we have to still guess, hey, is this upcoming quarter. By them not giving us preliminary results, the most common thing could be, hey, look, guidance was probably in line with what they're seeing right now. And we're going to look at guidance and how much revenue growth that's expected to be. Two, it could be, hey, look, we're actually getting better numbers and we're just going to show it to you at the earnings. Or three, our numbers could be worse and we're going to show it to you on earnings. So I'm actually leaning to the first two, either being better or being what the guidance was expected to be. So if the reason an analyst says that there is risk because of a lack of pre-announcement, in my opinion, that shows that they're just trying to move stock price here and there based on non-events. This is a non-event. It just gives us the, hey, look, we don't know which way it's going to go during earnings, just like every other company. Now, I mentioned we're going to look at what they expect for quarter three. So for quarter three, revenue is expected to be roughly $3.9 billion by analysts, right? And analysts, this would represent roughly a 207% year over year growth. Earnings per share is expected to be $5.76, which represents a 253% growth. Now, Supermicro obviously gave us their guidance, and their guidance is actually pretty in line with what analysts expect. Remember, analysts were expecting somewhere around $3.94 billion. Supermicro expects somewhere between 3.7 to 4.1, so somewhere around that midpoint. And in earnings per share, they expect roughly $5.20 to $6.01. Again, very similar to that midpoint here from earnings per share from analysts. So Supermicro is pretty much expecting what most analysts is expecting as well. And again, this is non-event. It's pretty much just like every other company where earnings are going to be earnings, and we have to figure out there if they beat, if they miss, or where they're right in guidance. Now, there are some great news for Supermicro investors earlier this week. On Tuesday, April 16th, Loop Capital adjusted Supermicro's price target to $1,500 from $600. Let me repeat that again, 1,500. I might have said that a little bit funny there. So $1,500 from 600 and maintains a buy rating. Another thing that we did see is TSMC just reported earnings yesterday, and TSMC is a big company that provides a lot of semiconductor solutions, and they're definitely in the top of the semiconductor chain. So during those earnings report, and let me just pull out this presentation, TSMC mentions that the budget for a hyperscaler player, their wallet share has shifted from traditional servers to AI servers. And obviously that bodes well for Supermicro because Supermicro, most of their revenue growth is coming from the AI server side. So if TSMC is seeing this huge pressure in the AI accelerator space, in the AI market, in AI servers, then that obviously trickles down and bodes well for Supermicro. Now, I did mention that, hey, look, I'm not a huge fan of Supermicro in general. And my main reason is not for anything negative. I think every stock always has the opportunity to outshine and do well. But now I have to like the valuation in forms of the business. If we take a closer look, PE ratio forward, which is the end of this fiscal year, so about not at the end of the fourth quarter, so about 3 months from now, is expected to be 34.9. I don't think it's necessarily completely expensive, but it's not cheap. At the end of the day, this is to some extent a hardware company with hardware margins and very, very heavy competition. Now, PE ratio for 1 year, which is pretty much a year and 1 quarter, so the end of next fiscal year is roughly 25. I mean, it's starting to get a little bit more attractive, but I personally believe there are big tech companies out there that have very similar PE ratios or very similar PE forward ratios that I would rather invest on. Obviously, valuations have come down a nice amount right now. 24.7 doesn't seem too crazy. Maybe if it gets to the low 20s or the high teens, I might definitely change my mind on valuation. So I hope you guys enjoyed today's episode. Let me know what you guys think. Take care, have a good day, and see you next time.